So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's ThePulicegroup.com/contact.
What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to talk about filing tax extensions and making estimated tax payments. So let's start with the tax extension. What exactly is a tax extension? Well, the IRS provides an extension of time, usually up to 6 months, to file your taxes. So businesses with a filing due date of March 15th, that would be your S corporations and partnerships, and individuals that file on April 15th, along with C corporations that are normally due on April 15th, receive an additional 6 months to file the return. So those business returns due March 15th are extended to September 15th, and the individual and C corporations normally due on April 15th are extended until October 15th. Now, the initial due date for trust tax returns is also April 15th. However, an extension for a trust filing a Form 1041 only goes to September 30th. So in that case, you have 5.5 months. Now, the extension is simply an extension of time to file your return. The taxes are still due by the original due date, so April 15th. And remember, S corporations and partnerships, their pass-through entities generally do not pay taxes at the entity level. That income is going to pass through to your individual return and will be due April 15th. So why would you file an extension if all it does is give you more time and you still have to pay your tax liability by the filing deadline in April? Well, the extension, first, it gives you more time to gather your information and helps ensure you file a more accurate return. When you give things to your CPA in the middle of March, their biggest concern is making sure they get everything put together, getting it as accurate as possible and out the door. When you have more time and you're working at a more relaxed pace, you can work in some planning opportunities for the upcoming tax year and get a much better feel and touch for your tax return from your CPA. That extra time really does help, especially when you're running a business. If you have a very simple return, odds are there's no need to extend. But with the business return, it can also buy you time to help manage cash flow. So, for example, you have until you file your return, including extensions, to fund a SEP IRA or make the employer match for a 401k plan. So you can make a deductible contribution to your SEP IRA or the employer match for your 401k for, let's say, the 2023 tax year up until October 15th or September 15th if you're an S corporation or partnership of 2024. So let's say you're an S corporation and you fund a SEP IRA each year. Your 2023 deduction or your 2023 SEP contribution could be up to, let's say, $25,000. Well, if you extend your S corporation return, instead of filing March 15th, you have until September 15th. That gives you until September 15th, 2024 to actually come up with the cash to fund the SEP IRA for 2023, yet you still get the deduction in 2023. So that's another reason to file an extension, some cash flow management. You're also statistically less likely to be audited when filing an extension. Now, that doesn't mean if you file a return with a bunch of red flags, an extension is going to save you. It definitely will not. Overall, you're just a bit less likely to be audited looking at the numbers of audited returns. I suspect a large part of that is you have more time to ensure everything's accurate and complete when you file a return. You're less likely to amend a return that's filed on an extension. So we, at our firm, we typically file extensions for most of our business clients. Some file on time, but at year end or in early January, we calculate the tax liability and we know what needs to be paid by April 15th. So we'll make a payment for the extension and we'll typically wrap in the first quarter estimate for the current tax year as well with that extension payment, make the payment on time, and then wrap up the return on extension When we have more time to pull things together, we have more time to sit down and have conversations with our clients during the summer months when things are a bit slower. And by building in that first quarter estimate, you're basically ensuring you're not going to underpay and subject yourself to penalties. You'd apply the refund with that first quarter estimate to the next tax year, and then roll everything forward and start making your estimates for the current tax year. So as you get later in the year, too, if you're filing your return later in the year, you have a better idea of what the current year income is going to look like. You can make some adjustments if necessary to things like maybe funding your SEP. Maybe you decide you don't want to max out the SEP this year for whatever reason. You have more time to make those decisions. You have a better idea of what the current tax year is going to look like and can build in some planning in the middle of the year. So those are the benefits to filing an extension. More time, typically a more accurate return. You can build in some planning and it helps you manage cash flow. So now let's touch on estimated tax payments. So the IRS requires that you pay your taxes throughout the year. So when you're a traditional W-2 employee, most of your taxes paid through withholding. If you make $75,000 a year, you might receive $50,000 or $55,000 from your employer. The rest is withheld and paid to the IRS and state tax agencies on your behalf. When you're running a business, when you're paid $75,000 from your clients, you receive $75,000 and you're responsible for taking care of those tax payments. So you're responsible for making estimated payments to ensure you don't pay in too little during the year and get hit with underpayment penalties. An underpayment penalty is essentially like interest that the IRS assesses. So they expect you to pay in at least quarterly a proportionate share of your tax liability for the year. It needs to be at least 90% of your current tax year liability. That needs to be paid in quarterly throughout the year. And then if there's a difference, you pay that at the time you file your return. So you need to get at least that 90% of your tax liability. Now, for some reason, the IRS has their own quarterly end dates, which aren't always 3 months apart, and they don't necessarily coincide with a traditional quarter end. So those due dates are April 15th for the first quarter, which covers January through March, June 15th for the second quarter, which is a bit odd. It's only 2 months, so it covers April and May. It doesn't cover an entire 3 months. And we have September 15th due date for the third quarter, which covers June, July, and August. And then January 15th is the due date for your fourth quarter estimate, and that covers 4 months, September, October, November, and December. Now, there's two ways or two methods to pay your estimated tax payments. You can base it on actual income, so you use the actual income for the year, which remember, your total estimated payments throughout the year needs to equal at least 90% of that total tax liability. So you're going to use the actual income, or you can use the safe harbor method, which that allows you to look at the prior year tax liability and base your estimates according to that. Now, this can lead to surprises at the end of the year when you file your return if you're not careful, but it does eliminate that underpayment penalty. So if you pay in at the safe harbor, you will eliminate the underpayment penalty. Now, many times as business owners, you don't know exactly what your income is going to look like for the year, especially early in the year when you're filing for first or second quarter. So that's where the safe harbor method comes in. So if you pay in according to the safe harbor, you don't have to worry about getting your quarterly payments exactly right based on the current year, and you don't know what your tax liability is going to look like. So you can use the safe harbor, which if your income's less than $150,000, the safe harbor is equal to 100% of the prior year tax liability. So if your tax liability for 2022 is $30,000, you need to make sure you pay in equal to $30,000 for the current tax year if your income was less than $150,000. Now, if your income exceeds $150,000, that safe harbor is now going to be 110% of the prior year tax liability. So let's say, we'll go through an example. Let's say your income is $200,000 a year. Last year, your total tax liability was $40,000. The safe harbor for this year would be $44,000. Your income's higher than $150,000, so it's 110% of last year's tax liability. Now let's assume you own an S corporation where $100,000 is your salary and the remaining $100,000 is your profit. Since you're paying yourself a salary for the S corporation, you issue a W-2, you will have some withholding. Let's say your withholding on the W-2 was $25,000 for federal taxes. That means your estimates, you need to pay in a total of $19,000 with your quarterly estimates, or roughly $4,750 per quarter throughout the year. That's going to get you to your safe harbor. Now, when you file your return at the end of the year, this is simply a reconciliation of what you owe and what you've paid in during the year. A refund just means you paid too much during the year and the government's returning it to you. If you owe money, then you didn't pay enough and you need to make up the difference when you file. This can be a bit confusing, but I feel like when you think of it as a reconciliation, it helps make it a bit more clear. There's really nothing, getting a refund isn't a good or a bad thing necessarily. In fact, if your refund's too large, you've basically given the government an interest-free loan. So when you think of it as simply a reconciliation between what you owe and what you've paid during the year, I think it makes it a bit more clear what's happening when you file your return. Now, to summarize, we'll go back. There's nothing wrong with filing an extension. An extension simply gives you more time to file your return, up to an additional 6 months. It doesn't extend the time to pay your taxes. So the taxes are still due by the filing deadline. When you file an extension, you generally want to make sure you pay what you think you owe or your best estimate, and maybe add in that first quarter payment for the next tax year to make sure you've got enough covered for the current year. The difference gets applied to the first quarter estimate for next year, and you make sure you avoid any late payment penalties. So the extension gives you more time to get your accounting in order, really tie things down. It can buy you time to manage cash flow for things like an employer-funded SEP IRA or the employer portion of 401k contributions. With your estimated taxes, these are due on the IRS quarter dates, which are different than the usual quarter end dates. So the IRS quarters are April 15th for first quarter, June 15th for the second quarter, September 15th for the third quarter, and January 15th for the fourth quarter. And again, there's two methods to pay: the actual income, where you pay estimates based on what your actual income is going to be for the year, or the safe harbor, which is based on the prior year tax liability. Again, this could lead to surprises if you're not on top of things, but it helps you avoid that underpayment penalty. And you can always adjust your estimated payments later in the year. If you've paid in first quarter, second quarter, and third quarter and realize your income is going to be lower than expected, you can reduce or eliminate the fourth quarter payment. If things end up looking like they're going to be a little bit better, you can increase it and help minimize the underpayment penalty. So you're not fixed at a certain estimated payment for the entire year. They can vary and you can adjust them as necessary. So that about does it for today. If you found value in this episode, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.